Hello, I am Rawan Saber, and I'm gonna talk about my investment portfolio for the last period. Portfolio is a collection of investment, and I followed some steps to make my portfolio as optimal as much as I can. I determined the appropriate asset allocation for my investment depending on my risk tolerance and considering my own preferences. I also considered the time horizon of the investment, which was short term, and I picked the stocks taking into account the strategies that I chose. In addition, I made the optimal weights for each stock, and I I tried to keep diversification of my portfolio. First of all, asset allocation. Asset allocation is diversifying an investment portfolio to reduce the risk. So for me, I followed the strategy of age-based asset allocation. This investment strategy is made based on the age of the investor. So it recommends to subtract an investor's age from a base value of 100. For me, I'm a 20-year-old college student. So when subtracting my age from 100, we will get 80. So this is the life expectancy for me, and when it gets higher, my risk tolerance gets higher, so I can invest more in stocks and so on. So I decided to invest 80% of my investment in stocks, and because it's also stocks offering the greatest growth potential for the portfolio, and my portfolio goal is to grow a significant amount of money in short time. As I was said, I decided to invest 80% of my investment in stocks, and also intended to keep cash and liquidity in my portfolio. Keeping cash is allowing me to taking advantage of future opportunities and reducing volatility. How much can I keep cash in my portfolio? I take the advice of Mubashir's recommendations. According or given the Russian-Ukrainian situation right now, they recommended to keep at least 20% to 30% of the portfolio as liquidity. So I tried to, okay, we will keep 80% of the portfolio as stocks and around 20% cash. Regarding the portfolio itself strategy, I followed the swing strategy. I followed this specific strategy according to my time horizon because it's a short to medium term technique. It involves keeping open positions for few days, weeks, or even it can take a longer time. Swing traders must become familiar with technical analysis to guide them, and also may support their technical assessment with fundamental analysis. So I try to do that. I will consider this in the transaction. When picking assets, I try to pick assets from different sectors and industry to make sure I diversify the portfolio as much as I can to maximize return and reduce the risk. I also had some unique consideration for me when selecting stocks, that I don't intend to invest in sectors that operate in smoking or cigarettes or tobacco or what so on, and banking sectors. So I will start with the portfolio transactions itself. I divided the portfolio into three parts: first transactions, second, and third transaction. Here with the first transaction, each transaction has different justification for picking their assets and so on. The first transaction, I totally depending on Mubashir recommendations. Mubashir recommendations had made perfect portfolio for 2020 year. So I picked 10 stocks initially because I wanted to start utilizing 50% of the portfolio as a starting point. And I was concerned that these stocks include some of the oil and petrochemical stocks, as this was very recommended from Mubashir. So as shown here in the Excel sheet, I picked these 10 stocks here, and I started to make the transaction that I will talk about now to reach the optimal weight for the portfolio. But after I did that, when I get to buying stocks, I discovered that there are two stocks I can't buy because the help of Thunder application told me they are investing in dollars, and that's not available right now in Egypt. So okay, I adjusted that, and I will talk about this now. So what I'm doing, I will talk into the adjusted buying. I bought like the stocks here. I'm started with downloading the historical data for the stocks. I used the period from 25 April 2017 to 25 April 2020. As it's 5 years with monthly prices, like it's 60 period, I guess. So this is the historical prices. Then from the historical prices, I calculated the returns. As we know, the returns equals the ending price minus initial price over initial price multiplying 100. Or we can do here in Excel, as we see here the function ending price over initial price minus 1 multiplied by 100 for just make it easier. So I just did this function. After that, I just like okay and drag it to all the stocks like this, and this drag it all the periods here, all the 6 periods I got. Okay, after that I got the average monthly return by multiplying by getting the average of the return for each stock by the average function, and then I got the excess return. Actually, in the beginning I got the excess return to help me getting the covariance matrix, but after that I discovered an easiest way to get the covariance matrix, and I didn't use the excess return at all yet. So here's the excess return, and this is the covariance matrix. I would like to explain how I got the covariance matrix. Covariance matrix, I used the data here, and then the data analysis, and we will find here covariance. We will press OK. So we will input the range of the returns of the stock, and we will make sure it's grouped by columns, and we new worksheet and press OK. After doing that, we'll have here covariance in a new sheet. It will be like this, so it wouldn't be complete. So as we know, covariance is like each other. This side is it's just like the other side. So how can we do this? We do this. We do just copy, and when we get paste here, we get we do here from home, we get paste special, not like that, past values, and we get transpose values best special. So we got values and we did transpose, and okay. So when we do this, the values of the covariance matrix is just here, but just in the other side. So we want to copy this again and just paste it here. So we do this here, paste, and when we doing the best special thing, we do values and just skip blanks and just fill all and get the covariance matrix in a very easy way. So I didn't use the way of the excess return. After that, the risk-free rate is already given from EGX, and the annual return, I got the average monthly return multiplied by 12 for each stock. And after that, I followed the two approaches for my portfolio: equally weighted portfolio and the optimally weighted portfolio. Equally weighted portfolio, I divide 100 by the number of the stocks, so each one has equal weighting, and the sum must equal 1, of course, and then calculate the expected return, risk, and Sharpe ratio. Okay, expected return for the portfolio, we calculated by the function mult transpose the weight matrix multiplied by the annual return. But when we get to the optimally weighted portfolio, here is the risk in the first. We do this by the function square root mult transpose then the weight matrix, as we can see, then the covariance matrix, then the weight matrix again multiplied by 12 to get the annual risk. Sharpe ratio, we get it by expected return minus, here as we can see, expected return minus risk-free rate divided by the risk. So Sharpe ratio, when it's higher, it indicates that the portfolio is diversified more, so it's a good thing actually. Optimally weighted portfolio, we did different thing. We used here Excel solver. So in data solver, we put some constraints. First of all, the objective of us, we maximized the Sharpe ratio because we needed to be maximum as much as possible to make the portfolio diversifiable, and we changed the variable cells, that is the weights, and we put 3 constraints: that the sum of all stocks equals 1, and also I determined that the stocks has minimum investment of 5% and maximum investment of 20% to make sure that it's also diversified well, and solve. So it just get us the result, as we can see. Expected return, we put also the function as before, the risk and the Sharpe ratio. So as you can see, the optimally weighted portfolio has higher return in around equal risk and also higher Sharpe ratio, so it's well better than the equal weighted portfolio. I want to say what did I do when I know that there is 2 stocks that I couldn't buy. I did something called that rebalance. Wait a minute. Okay, here is the rebalance. Okay, so I had 10 stocks. Like, I decided to invest 50,000 of my 50% of the investment, which equals 50,000, in 10 stocks, and I started to buy stocks, but I bought only 8, and there's 2 I couldn't buy. So the percentage that I bought the 8 is not the efficient thing I wish to. So I did something called rebalance. After I did that, after I did the adjusted thing, that I did the weighting again in a different way only in 8 stocks. I went to the rebalance with the new weights and with the current percentage. I get the current percentage by dividing the current asset over the total asset, and the desired assets by multiplying the desired percentage with the total asset, and then I get the difference that determine which I could sell it or buy this difference. Okay, so I will go to the second transaction because I got a little time now. Okay, with the second transaction, I choose the stocks depending on the technical analysis, and I used moving average to reduce price volatility and it forecast price patterns in financial markets. I used the one popular technical indicator, the simple moving average. It is customizable over different time, but I used a specifically the 20-day simple moving average because it may be of analytical benefit to a shorter time trader, since it follows price more closely and therefore produces less lag than the long-term moving averages. Okay, so I have 8 stocks and I bought more 10 stocks, so I have 18 stocks as showed here. So I got also the historical data from investing with the same time period. Then I got the return in the same way, and here I discovered a very huge mistake I did in the first transaction. I discovered that instead of dividing the end price over the initial price, I did the opposite. So it made a lot of mistakes in the first, but I tried to make it clear. Sorry, it's not like that. Okay, I tried to fix this, but from the second transaction. Okay, so I did the returns as before, and I did here the covariance matrix as I told you, and I got here the mean, which is the average monthly return, and the variance by the function variance, and the standard deviation, a square root for the variance, and so on. And I got the equally weighted portfolio and the optimal weighted portfolio as before, all as before, but in 10 stocks, and also the optimal weighted portfolio was more better. The difference here, I got the beta for the portfolio. I used portfolio return and EGX return, which means the market return. I used EGX 30 as an index for the market because it has it collects the most 30 company of the market from liquidity and activity. Portfolio return, it was very long function, but it's so easy. You multiply the weight of every stock, each stock by its value of return, and you combine them each together, and you got the portfolio return for the whole stocks. And EGX return is available, and then you got the beta. I got it by 2 methods: beta by the function slope, then portfolio return and EGX return, or by the function regression. Here, data analysis, we got regression. Okay, and input here portfolio return in the Y range, and in the X range we got market portfolio market return, and then okay, so it will produce all of this, and this is the beta of the portfolio. Okay, for the third transaction, I bought the stocks here also because of their technical indicators, and also I tried to involve some fundamental indicators like price to earning ratio that determine the well-established company, and price to book ratio that it's the current price on the market to its book value, and any stock under 3 is reasonable valuation. Because this, I followed this method. So here in the third transaction I did all the same, but I bought 10 stocks and I sold 6 stocks because their indicators was very bad and strong sell and so on. So I did all of this, but on 23, after, of course, uh, um, by selling 6 stocks, I did the rebalancing before this to sell the 6 stocks, and I did all transaction here on 23 stocks. Okay, I got the beta, I got the optimal weights, and all of this the same. Here I did the plus. I got the portfolio performance according to the market, and we can find here that the portfolio is less volatility than the market, and the percentage of portfolio which is more very diversified. Okay. Portfolio performance actually in Thunder was very good in the last 2 days. I got a profit in the last 2 days, 0.5, and that's it. I just recommend for future work that I can design portfolio tracker and dashboard, because I couldn't make it because AGX company less than AGX aren't available in Excel, so it was very hard. And make more specific charts and stock watch list and so on, because this was not available with not availability of ticker and stocks in Egypt. That's all. Thank you so much. Thank you.